Have you ever looked at your paycheck, your savings, or your retirement account and quietly wondered if it will still matter 10 years from now, or if the job that pays for your life today could simply disappear tomorrow because a machine learned how to do it faster, cheaper, and without rest? Across the United States, people are working harder, but feeling less secure. Inflation keeps eating into savings. Rent and groceries rise, while wages struggle to keep up. Markets swing wildly on every CPI report, every Federal Reserve meeting, every unexpected jobs number. And in the background, almost unnoticed at first, artificial intelligence keeps moving forward, rewriting what work even means. This is Crypto Brainpower, a channel built to help beginners understand markets without hype, fear, or false promises. Here, we focus on learning, patience, and long-term thinking in a world that feels increasingly uncertain. Before we go deeper, I'd like to know what stock market or economic topics you want us to explore next. Share your thoughts or experiences in the comments, because many of the best discussions start there. Subscribe to support the channel and continue learning with us. Now let's slow down and look at what is really happening. Not headlines. Not panic. Reality. Artificial intelligence is not arriving in the future. It is already here, quietly embedded in offices, warehouses, call centers, and financial systems. Customer service chats are increasingly handled by software instead of people. Basic accounting tasks that once required junior staff can now be automated. In logistics, algorithms decide routes and inventory levels faster than any human team. In finance, trading systems react to news in milliseconds. For many workers, this creates fear, and that fear is understandable. Historically, when technology changes how work is done, some jobs fade away. Think about travel agents, video rental clerks, or newspaper typesetters. AI is different only in speed. It does not just replace physical labor. It touches thinking, analysis, and decision-making. But markets do not only reflect fear, they reflect adaptation. Every major shift in technology has destroyed some roles and created new systems, new companies, and new long-term winners. The stock market is not a moral judge. It is a mirror of economic change. Consider large U.S. companies that already rely heavily on automation. Amazon operates massive warehouses where robots move goods with precision, reducing costs and increasing efficiency. Tesla uses automation and software not just in manufacturing, but in how vehicles learn from data over time. Apple integrates AI into chips, devices, and services, often in ways users barely notice but benefit from daily. These companies are not immune to market risk. Their stock prices fluctuate. They face competition, regulation, and economic cycles. But they share one trait. They invest heavily in automation to protect margins and scale operations. In an economy pressured by rising wages and global competition, efficiency becomes survival. Zoom out further and look at the S&P 500. Over time, the index shifts its weight toward companies that adapt and away from those that fail to evolve. This is not instant. It happens slowly, often painfully, during earnings seasons, layoffs, and reorganizations that never make the evening news. Many retail investors in the U.S. first encounter these stocks through platforms like Robinhood, Fidelity, or Charles Schwab. The experience can feel overwhelming. Charts move fast. Headlines contradict each other. One day the market rallies on a strong jobs report. The next day it falls because the Federal Reserve signals rates may stay higher for longer. AI-related optimism often collides with macroeconomic reality. Automation can boost productivity, but it does not eliminate recessions, policy mistakes, or human emotion. This is where many beginners get lost. They hear that AI is the future and assume that every company using the word will succeed. Markets do not work that way. Risk is real. Automation can lower costs, but it can also invite regulation. It can improve efficiency, but it can also reduce consumer trust if used irresponsibly. Stocks connected to AI and automation can be volatile, especially when expectations run ahead of earnings. Long-term market history teaches a quieter lesson. The investors who survive are rarely the ones who chase every trend. They are the ones who try to understand systems. How technology affects productivity, how profits are generated, how economic data like CPI and employment reports influence interest rates and consumer spending. Think of automation less as a single bet and more as a slow shift in how businesses operate. Banks use AI for fraud detection. Healthcare systems use it for diagnostics and scheduling.
Retailers use it to predict demand.
None of this guarantees stock performance, but it shows how deeply automation is woven into modern business. At the same time, some jobs will shrink. Repetitive tasks, basic data processing, and simple customer interactions are most at risk. This does not mean people become useless. It means skills change. Markets reflect that transition with both opportunity and pain. During periods of uncertainty, it is easy to feel frozen. Many Americans hold cash because they fear another market drop. Others invest emotionally, buying after rallies and selling during panic. Neither approach builds confidence. Understanding does. When Federal Reserve officials speak, markets listen because borrowing costs affect company expansion. When CPI comes in hot, stocks may fall because inflation threatens profits. When jobs data weakens, fears of recession rise. Automation exists inside this larger system. It does not replace it. The calm investor accepts uncertainty. They do not expect guaranteed returns. They understand that progress comes in cycles, not straight lines. They focus on learning, not predicting. If there is one quiet advantage in studying automation and AI, it is perspective. You stop reacting to every headline. You start seeing patterns. You recognize that fear and optimism take turns driving prices, but long-term value depends on execution, discipline, and adaptability. In a world where jobs evolve and technology accelerates, patience becomes a competitive edge. Not because it avoids risk, but because it allows time for understanding to compound. The stock market has always rewarded those who respect uncertainty and stay curious. Automation is simply the latest chapter in a very long story. This video is only for educational purpose, not financial advice.